It's possible that you won't have many opportunities to live comfortably in your 20s or 30s even, if you're not planning ahead for retirement. It goes without saying that you need to acquire a large amount of cash, and investing is one of the finest ways to do this, especially for the working class. So getting a head start on your savings is a great idea. Here's a great illustration of how investing early might help you amass a substantial fortune. If you begin investing $500 per month when you're 25 and keep it up until you're 60, you'll have $2.16 million when you retire, assuming an annual return of 8%. If you started investing at age 40 instead of 25, though, you'd end up with only $341,000. This basic illustration, which ignores inflation and instead assumes an investment will grow at a rate of 8% per year, is not novel. I previously warned you that this is old news, so you've undoubtedly heard it before. While this may not be the case for everyone, for the vast majority of us, starting early is still the best strategy for increasing wealth and ensuring that you have a significant reserve to deploy in tough times. So in today's video, we'll talk about some of the best investments you can make in your early life. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. Let's get started. The investments I will discuss in this video are listed on the screen in no particular order. Now let's begin with the safest option, index funds. If you're under the age of 40, equities are among the best investments you can make. You will have many opportunities to make mistakes and learn from them as you begin your financial journey. But you should always make well-informed decisions because they may be extremely hazardous, but also have some of the largest possible returns. S&P 500 ROEs typically average 10%. Almost no investment will yield a profit in the long run. Bonds with such a high yield could prove useful in building an index fund portfolio. If you're looking for a low-risk investment, look no further than bonds. Bonds offer more security as an investment. Thus, a 10% to 20% allocation in your portfolio is recommended. Index funds for cryptocurrencies were currently established. They appear to be quite promising, even if they have not yet undergone rigorous testing. You may also provide the percentage and adjust it based on your level of risk tolerance. Returns currently range from 10% to 15%, which is very good, but the associated risks are also increasing. One of the main benefits of index funds is that they have lower management fees, which means that your return on investment will be higher. Aside from helping spread your risk, many index funds' low annual expenses are a key selling point. Expenses are a surefire way to eat your profits, so it's important to minimize them whenever feasible. When investing in index funds, it is important to keep the tax implications in mind. Number 2. Real estate. One of the best investments is real estate, and it's one in which you nearly never go wrong for a number of reasons. Housing is in short supply, and real estate assets almost always increase in value. Buying a house is the first stage in real estate investing because it allows you to save money on things like rent. After settling into your home, you may start thinking about expanding into other types of real estate development, such as multifamily dwellings, townhouses, or commercial buildings. Crowdfunding platforms allow investors to put in as little as $500 into real estate projects. So even if you can't afford to buy a property outright, you can still get in on the action. The money would be put forward buying real estate and making charitable contributions. These properties are referred to as Real Estate Investment Trusts, REITs. Thirdly, we must emphasize the importance of a good education. According to research, your 20s are prime time for learning new things. So now might be a good time to go back to school and acquire that advanced degree you've always wanted. While it's true that a college degree might boost your career prospects, it's important to remember that not all knowledge is created equal. Proceed with caution, as some research may be considered a hobby and not cost you anything. If you're thinking about going back to school, it's a good idea to begin by thinking about the fields that interest you and could lead to a successful job. As an added bonus, you may have found the perfect time to better your understanding of personal finance. Number 4. Startup business. Invest in a startup when it's still in its infancy, because the rewards of business ownership are virtually limitless, and your return on investment, or ROI, may be as high as you make it. In your 20s, you should also consider investing in a fledgling business, because even if it doesn't become the next Amazon, it still has a great chance of producing a return that will skyrocket. Even if you're too young to have started your own business yet, you can still benefit greatly from investing in those of your elders in exchange for equity in those companies. Number 5. Treasury Bills. All investors, regardless of their age, must buy Treasury Bills. Treasury Bills are short-term government guaranteed debt instruments used to support spending and control the money supply, and there is no better time than your youth to make regular purchases of these bills. Everyone has costs to pay, whether it's for school, housing, certification, or examinations. The 90-day, 182-day, and 364-day tenures of Treasury Bills can help. You can invest your spare cash in Treasury Bills and get the money when the notes mature. As an example of the financial concept of asset and liability matching, wherein an item is bought in order to provide money for the payment of a future responsibility. This situation illustrates the need to buy an asset in order to meet a future financial commitment. As opposed to other forms of investing, Treasury Bills carry zero inherent risk, guaranteeing you a return regardless of market conditions, since they also provide satisfactory rates of returns. Why not put your money into them? Number 6. Growth stocks and dividend stocks. We've made it plain that if you're between the ages of 20 and 30, you should take chances. You have plenty of time to recover from any setback, and investing in the stock market is a terrific method to do just that. Simply put, growth stocks are investments whose expected yearly growth rates are significantly higher than the average of their respective industries. Dividend stocks, on the other hand, are typically more stable than growth stocks because they are owned by established, financially stable corporations. Incorporate dividend-paying stocks into your portfolio as soon as possible. If the firms continue to perform as they are, you'll be able to count on a reliable stream of income for years to come. Number 7. ETFs, or exchange-traded funds. Let's look at ETFs that are similar to the index funds we discussed before. Due to the fact that ETFs are baskets of stocks, bonds, and other assets, they are similar to index funds. Shares are exchanged on a market just like stocks are, making them a viable investment vehicle for a wide variety of sectors and industries. Number 8. Commodities. In economics, a commodity is a good or resource that is widely accepted to be interchangeable between different manufacturers without affecting the market price of the good. One option is to purchase physical raw materials such as precious metals in varying quantities and store them away for future use. Exchange-traded funds that track a specific commodity index or futures contracts are another option for investors. Commodity investing includes advantages such as portfolio diversification, potential profits, and hedging against inflation. Number 9. Annuities. An annuity is a contract between you and an insurance provider that stipulates the provider will make periodic payments to you, either immediately or in the future. Several annuity contracts exist, each of which allows you to acquire an annuity with either a lump sum payment or a series of premium payments. Some people still combine their investments in their retirement savings, despite the fact that doing so might lead to financial hardship. If you utilize an annuity as a savings vehicle, but the insurance company delays paying you out, you have a deferred annuity. A big commission on an annuity may be 7% or more. However, if you use the annuity to provide a source of retirement income and payment begins immediately, you have an instant annuity. Concluding with the discussion of the top 10 topics in the industry, we come to a growing number of Wall Street financiers are showing an interest in cryptocurrencies and initial coin offerings, or ICOs. But with more than 1,000 different cryptocurrencies in circulation at present, it's crucial that they fully understand the nuances of these investments and the risk they entail before making any commitments. In any case, we know that the returns are extremely high, anywhere from 13% to 200%. Sometimes initial coin offerings, or ICOs again, do extremely well. For instance, the OTA received a return on investment of 13,000 times, meaning that an initial investment of $1 would now be worth $13,000. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.